Welcome to TQ Talks, where taxes meet planning. Here's your host, Craig White.
Welcome to another episode of TQ Talks. I am your host, Craig White, and I'm happy that you're with us or with me today. Just a quick note, the format of the podcast is changing to a solo only because the company is growing, and thank you, God, for the growth. It's Patrick and Sebastian are still there. We're still going to be on together and still talk and have the same banter that we usually have, but everybody has different responsibilities, and unfortunately that leads to time being better utilized by all of us, and that means I'm taking this on because it's a little bit easier for me. So again, we look forward to you continuing to join us. I say that because all of us are still going to be here and participating in it. But moving forward, we're just going to try to keep it solo until time or abilities allow us to get all together and get back to our normal format. But without further ado, again, thank you for joining us. We're starting off this tax season, and we wanted to start off by picking up right into this whole SALT deduction thing, right? Everybody reads the headlines. I'm sure you've seen it. It's a $40,000 SALT deduction. It's increased, and everybody's texting and trying to figure out what is happening and how does this affect me. And we're going to get into that, right? We're going to talk about it. We know you saw it. We know you understand what it is. But the questions, of course, like I said, it's going to be, does it affect me? Is it tied to my mortgage? Does it help me when it comes to my business taxes? Is it a big deal, right? Or is it just another fluffery garbage that gets thrown out there? So in today's episode, we're going to try to answer that for you, or I'm pretty sure we're going to answer it for you. We're going to slow it down, address all of the misnomers, right, the misunderstandings of it, tell you what it actually covers, who it impacts, cut out all the hype, and just give you the real information. So to start off with, I guess we should define what it is. SALT is an acronym, right? It's state and local taxes. It's pretty simple from that. Again, state and local taxes. So it's state income taxes or state sales tax. You get to choose. And then it usually, or does include, I should say, real and property taxes, like things like your homes or vehicles or boats, etc. But that's it, right? One of the things that people assume, and I used to way back in the days, like when you hear this, you automatically assume that mortgage interest is part of the SALT deduction, and it's not. It's completely separate. And I think people automatically make that assumption because if you start to itemize, which we are going to explain, if you start to itemize your taxes, mortgage interest is part of that. And you automatically think, well, I guess it's SALT. I don't really know what it is, but it's $40K, so it has to include that, but it doesn't. The SALT, again, deduction is only the state and local taxes. And that's something you want to know. So going into the whole itemization portion, if you itemize your taxes, which means you're using a Schedule A, right? And I guess we should talk about that. I know we have other podcasts where we break down standard deduction and itemized deductions, but for this purpose, if you don't know, I can do a brief recap just to make sure that you know. But again, before I get there, the SALT deduction is a personal deduction. It's not a business expense. It's not something that goes against your S-Corp income, even though, we might touch on it, there is a little leeway on that, and I'll get into it. But it doesn't affect the profit of your business. It's even if you're a business owner, the SALT is literally just a personal side of the return. And I don't care if you're S-Corp, C-Corp, a single member LLC, it's something that you need to understand. It's affecting you on the personal side, on the 1040. So again, we're back on that itemized deduction portion. The standard deduction is the standard amount of money that the government gives you that goes against the income that you have. And I'll give use numbers, I should say, to better help you understand. And these are not factual numbers. I'm giving even numbers because the calculations make life easy. If you were a person that in a perfect world made $100,000 and the standard deduction for a single individual, for example, is $15,000, then if you paid taxes on 100 and then filed your taxes, and you'd get back a refund because the government would say, hold on, you pay taxes on 100, but we're going to give you a standard deduction, which covers a whole bunch of things: charitable contributions, mortgage interest, property taxes, state taxes, local tax, all that stuff. And then it says, hey, because you overpaid, all right, because your real taxable income is only $85,000, we're going to give you some money back. Great. That's wonderful. Wonderful. So $15,000 would be the standard deduction. Again, not real. It's like $15,750 or something like that for a single individual. At least we're in, what are we, 24, 25, 26 now? I got it, Lords. Anyway, but for the itemized, or the sake of itemization, if you are able to produce multiple things, whether it be mortgage interest, property taxes, right, state, local taxes, that's the whole SALT portion, charitable contributions that exceed, that are more than, here we go with that 15,000 that I gave you as the example, then you would itemize your taxes because you want the bigger of the two numbers. So for those people who think, oh my God, I contributed to church and nothing happened, and what's the point? Don't panic. The biggest number, whether it's standard or itemized, is going to be the winner. Either way, you're in a good position. But back to the SALT deduction. The purpose of all this is to understand that the state and local taxes, the mortgage interest, and the charitable contributions all contribute to your itemization, state and local being what we're discussing now. So again, the real question is, okay, well, that's cool, but who does this SALT increase, this $40,000 increase or $40,000 increase help? Well, it's going to help high income earners or people who have extremely high property taxes, right? The SALT deduction, just to make sure you understand, is something that was added from the One Big Beautiful Bill, and it's going to go from 2025 to 2029. And again, for most filers, it's $40,000. But if you are married filing separately, it splits it. It goes down to $20,000. So again, we started back before 2024. It was capped at $10K. We move up to $40K. That's $30,000 additional, which is a big deal. But married filing separately is $20,000. Still, not what you want, but it's better than it was before. So unless Congress changes something in 2029, 2030, it's going to go right back to that $10,000. So you have some years to utilize it. So again, with a $40,000 cap, you can deduct a combined total, right, of state income taxes and sales taxes, real property taxes, and again, you're putting it into their own category. In addition to that, in order to itemize, you're then adding mortgage interest, blah, 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 again, charitable contributions. So phase outs are always there. The IRS doesn't give you anything without some kind of nuances with it. So the $40,000, why am I struggling to say $40,000? This is crazy. The $40,000 SALT deduction begins to phase out once your modified adjusted gross income exceeds $500,000, $500,000. Then as that money continues to go up, the SALT deduction continues to go down, the amount that you're allowed to do, right? So hopefully that's a problem that we all have, but for most of us, it's not a big deal. So again, it phases out or starts to phase out once you are 500,000 or more, but that's exactly where the whole tax planning thing comes in, because if you're in that position and you're trying to take advantage of the itemized deduction and SALT is part of it, then you really do want to figure out what you need to do. Do I need to contribute more on the charitable side because I'm not going to get the full $40,000? Those are things that you have to talk to your preparer about throughout the year, not when it's tax time, so that you can better be able to deal with exactly what comes in. Now, we're in Florida, which is, I'm saying that not because it's a brag and you guys are probably freezing right now, but it's because we don't have state income tax. And sometimes, or a lot of times, people sit there and think, well, man, this SALT thing is just great for everybody else because they have they have local taxes and we don't have state taxes. I don't understand. But remember, property taxes are a big deal, right? And so in places like California, New York, and South Florida, property taxes are high, right? They're fighting right now to get rid of them. So ultimately, even though you're missing one part of it on the SALT, it's okay because it's not an automatic loss. You do have the ability, depending on the price of your home, et cetera, to definitely take advantage of it. Now, for you business owners who feel slighted, there is something that is out there called PTET is the short, but it's a pass-through entity tax. And the simple explanation for it, for those who are S corps, partnerships, C corps, I should say not C corps, LLCs, anything that has a pass-through, what it does in layman's terms is it says, hey, on behalf of the business, you can pay into those sales tax, right, into your state income tax at the business level. So that way you can take advantage of the $40,000 in case you do not qualify. I'm not going to dig deep into it. Each state has its own specific rules, and a lot of states do require that an election is made annually. So every year you have to tell them, right, before the end of the tax year that you want to do it for the next year. So again, it's an opportunity for businesses to take advantage of it. Again, I repeat it if you want to dig a little bit deeper into it. It's called the pass-through entity tax, and we don't see it very often. A lot of the times it doesn't really apply, but it is something that business owners do have the opportunity to take advantage of in case it's something you're looking for or trying to figure out, well, this is only for personal, and 9 out of 10 it is, but there is an opportunity for businesses as well. So one other note that I want to make sure I say before I forget it, the SALT deduction between 2027 and 2029, I'm trying to remember it, it does increase by 1% annually for inflation. Nothing crazy, nothing massive, but just relevant, right? For multi-year planning. If you're trying to figure things out, it does give you the opportunity to know that there's going to be additional money added to that $40K if you are a person that qualifies. So again, the take home is that the One Big Beautiful Bill did make that change. And for people who are, again, living in high tax states, again, we talked about it, California, New York, New Jersey, Florida, I'm still going to count us because it hits hard. And I know California, New York, and New Jersey are definitely higher, but this is something that it will help you if you're in those areas or this one because it's an opportunity for you. So the takeaway is this. It's a $40,000 SALT deduction that is being added or is added, and it is being used now. It is for state and local taxes only. It does not affect or has anything to do with your mortgage. It's usually not a business write-off, and it works only if you itemize. But I repeat, if you do not itemize, it's still not a slight to you. It's still an opportunity for you to take advantage of what's given. And it's based on, or usually I should say, it might be limited based on your income, right? Because if you're making over the $500K, we brought that up, that's what's going to happen. So it's still not a bad thing. The SALT deduction and the $40,000 increase will definitely help people who have spent a lot of money on their homes, or again, depending on property taxes, because even if it's not the price of the home, also location definitely affects that. And if you are a contributor to whatever it may be, organizations, you do charitable contributions, etc., the combination of all three, mortgage interest, charitable contributions, and the SALT, will definitely help you if you itemize. So if you were previously itemizing before this increase, you're probably in a really good position moving forward, at least the next 4+ years. And you should definitely make sure you speak to your tax preparer or advisor and let them know, hey, I bought a home or I have a home. I want to make sure you look at this to see if it will or will not help me when I file my taxes. So next episode, we're going to go into the no tax on tips. Lord Jesus, that has been one of the worst pieces of messed up information, and how you calculate it, etc., has been a nightmare for a lot of people. And we're definitely addressing it. We've done it on social media. We've done clips for that and the overtime, which we're going to definitely talk about on the podcast. But next episode, tune in for that. We will break it down for you, let you know who qualifies and how it works, and put a lot of clarity into it. So That's all for now for TQ Talks. We thank you. I thank you for joining us. I look forward to hearing or having you join us next time I'll say this, next week, because we're going to make sure we're doing this continuously as we tackle the next topic. And if there's something you want to hear from us, please let us know. Like, follow, share, all that good stuff. Find us wherever you get your podcasts. I'm sure my son will tell you that at the end. Have a great and blessed day, everybody. See you soon. Later.
Thank you for listening to TQ Talks. If you enjoyed the show, please rate and recommend on iTunes, SoundCloud, or wherever you get your podcasts. You can also get more information at tqfinancials.com.